Welcome back to Feed of Exchange, episode 24, winter break edition. We are coming to you from Zoom here, but excited to still get another holiday special episode over to you guys.
Yeah, we're back. Kind of gonna jump into it, recapping the year. It's been hectic. It's been a lot. We've covered a lot. So, kind of just taking a second to look back at what's happened. Overall, good year for the markets at least. S&P 500 looks like it's up to 18% now. We had some rate cuts to close out the year, getting close to that 3% mark. So tr 10-year treasury's gone down, and that's about where we're sitting right now. GDP numbers also just came in stronger than expected. So overall looks like a good year for the economy, but there's also been some hiccups along the way, of course. Um, I don't know. That's kind of where we're at right now.
Yeah, and we picked off one of these stories about the GDP growth, and this is from the Wall Street Journal, where it says it was the strongest expansion since the third quarter of 2023. Rising consumer spending was partly driven by healthcare, including outpatient services, hospitals, nursing homes, international travel, legal services, personal computer software, etc. Um, so I think that this was a surprising thing to read, I thought, especially just by how much it beat. I think I remember when we did the story where the GDP numbers showed a contraction, and obviously we're far from that now. So I guess it's a positive thing. But even reading out in like some of the sectors that we saw growth in and healthcare, like I don't know if that's even like a good thing. Like, are we getting healthier or are we just spending more money on healthcare because we have like more problems? To me, that's not a indicator of wellness per se, and even international travel, legal services, those seem like things that definitely probably serve the upper end of the economy. So I thought that those things were interesting just to always see like where, because it seems like that they have some of this data of where the GDP growth is actually coming from. But I don't know if there was anything like in the specifics there that stood out to you on any of the numbers that we got, because I know it's kind of a deluge of info.
Yeah, I mean, same thing with healthcare, looked like specifically outpatient services. So this is like your urgent care, it's not your overnight stays. So routine medicine pickups, whatever that entails. But as you kind of said, it can in a way seem like a facade, like, oh, GDP is up this much, but what does that really even mean as to your point? But article noted that again, consumer spending seems to be carrying the way here. We've kind of talked about this in the past, how a lot of it is actually from some of the wealthier Americans that are driving this, but nevertheless, consumer spending is still strong while hiring sluggish and consumer confidence is still in the dumps. I feel like we keep coming back to this. People don't feel like they're making enough money. They don't feel confident in where the economy is going, but they do continue to spend. So that's kind of some of the overarching themes.
And I was looking at the consumer sentiment stuff. These guys cited a different group. I think it was the Conference Board, but I was looking at the University of Michigan data that they had, and I thought that it was kind of surprising, like to think about themes from this year of like how much it ebbed and flowed that came into the year and then had Liberation Day and sentiment went way down and then it kind of roared back. And now we kind of finish off the year a little bit more sluggish. But I think it'll be interesting to see too, like once the holidays are wrapped up and everything, of what the holiday spend kind of looked like, and if we get information from the major retailers. I think usually we talk about like how Walmart and Target are doing, and to see how many toys came off the shelves going into Christmas time and that sort of data as well.
Yeah, that'll be good to look at. But I guess just when we're looking at this year as a whole, kind of wanted to raise a question. Maybe what's one word or one phrase you might use to describe this year?
Um, I was thinking of that this don't have a great word, but I would say something like unproven or untested. That I think that there's a lot of investment out there and bets being made. I'm sure we'll talk about some of them with artificial intelligence, with private credit and lending in that space, and that because there's been such an investment, I've just wanted to see like how resilient that like this is through a whole market cycle and where people are going to think and how much people are going to panic of if the market ever goes sideways of those investments. So that'd be the word I use, but I'd be curious to hear what you got to say on that one.
I was in between a couple. I think volatility is definitely an easy one. We saw some crazy swings. Of course, Liberation Day, you saw DeepSeek, where the market just kind of goes berserk, but then it comes right back. And that's kind of been the overarching theme. So maybe I'll say resilience as my other one. No matter what's kind of been hitting, it seems like the market's rebounded even when hiring's slow. Consumer confidence is in the dumps, still chugging away. So I'll I like resilience more.
Point to the optimism. Love it.
Hmm.
Love it. Love it.
Here we go.
And then I brought in this story too of just like a comparison because I think one thing that isn't always talked about that much about is what's going on in China. And China has had a stock market's had a great year. I believe their MSCI index is up around 30% on the year, which for how well we're doing in the US, that maybe you could have even gotten better returns by looking at some of these emerging markets is something that is very interesting. And I'll just start off with another quote from the article that I liked, is that on one hand, there's a thriving modern retail and technology sector with global brands and successes. On the other, 80 to 85% of the economy is still grappling with issues like economic imbalances, debt limits, and unemployment. And I think that China, in many ways, I think that there's almost like two distinct narratives in the news on it, is that, they're growing and they're coming for us. And then the other one is that like they're a total mess and that they had a big real estate crisis and look at how bad central planning and socialism is. So I'd be kind of interesting to hear like anything that you thought was interesting from the article or anything else that you've heard about China in the news.
Yeah, I mean, this is a big swing. I think that something it noted was that from, early 2021 until 2024, China had this really stubborn, completely bearish sort of outlook on itself. As you said, kind of the real estate crisis. But that sentiment seems to really be shifting, and especially in a world today where maybe we're moving away from globalization. And I know they cited, what was it, US excellence or US dominance might be withering away. And of course, DeepSeek is reflective of that. Maybe we don't need hundreds of billions of dollars of CapEx spending to have um, strong AI capabilities. So you kind of have to think about that. But China has been doing a really good job in the tech space. Um, but what they did note is that 80 to 85% of their economy, their population, is still struggling. The economic imbalances, debt limits, unemployment. So China has a lot of internal issues, and they're still very export driven, and they do rely on that to sustain this growth. And their consumers just aren't very consumption heavy. They don't have the wealth that's needed to consume everything that China's producing. So I think there's still a lot of problems internally with China and how the average citizen is faring, but it does seem like right now they're making some really profitable strides in the right direction.
Right, right. And I kind of have a weird relationship with that like consumption piece because like on one hand, like when we approach it in our class, it's like this is a problem. China should consume more, they invest too much, they export too much. And I kind of get that from the US perspective is that, yeah, you don't want them dumping all these goods on your industries and that they're bad for potentially your nascent industries and electric vehicles and green tech, etc. But if you're China and you have this choice between, okay, like, do I try and modify my policy to decrease investment to make sure that my people consume more, etc. Like maybe that's good for your people, but what they're probably more concerned about is trying to get the global supremacy that comes from you're able to export a lot of your goods on people. You get them relying on your stuff. You get control over these industries that you think have the longest runway ahead of them. And to me, I think that that's almost how the US is looking to respond in a certain way. Like when we think about the K-shaped economy, it's kind of a similar thing that we really are trying to make the environment as easy as possible and as deregulated as possible for people to A, invest in all these new kinds of products, have the best capital market solutions, B, in the United States, make sure that we do everything possible to keep these tech firms afloat and keep that cash cow running. And I think that we're almost letting our big firms like get as big as possible, get as powerful as possible, so they can potentially run with the big dogs and fight against China, et cetera, on that kind of front, at the expense of the consumption of like our lower classes, of our small businesses. So I think that we'll see like how that plays out, but that's just kind of a theory on what China's doing and us giving up on them trying to increase their consumption. Clearly it's just not in their interest to do so. And so I think that we're kind of modifying our policy to fit that. I don't know if you think that holds any water or if there's anything you think that's interesting there.
No, that's insightful. I think that what we've looked at before is just how China's really leaning into this green, clean energy expansion through solar and trying to export that and taking the lead there while the US kind of is on their back foot, trying to double down on coal and create negotiations um, in line with tariffs and on those same calls to, say the EU, you have to invest hundreds of billions of dollars in our coal industry over the next, whatever, 5 years or so. So, two different ways of looking at it. And maybe you have to think about can the US keep up and will they fall behind in some of these industries? But on the foot of tech and AI, it doesn't seem like they are. It seems like there's plenty of spending going there.
Right. I think the US, like they want to be the AI data center leader, so people are going to be relying on them for the technology, digital infrastructure, and it can maybe export the same stuff to the rest of the world. And I think that we've seen that with the NVIDIA chip story that we came to that agreement to say we're going to have a 25% extra tax on you guys selling those NVIDIA chips to China. And potentially that is a way that we can get other people hooked on some of our technologies and grow our footprint in that way. But that's also at the same point of NVIDIA's what is in wealthy people's portfolios, it's in their stock accounts, it's what's promoting their consumer spend, maybe at the expense of some other people, but that or I don't even know if it's at the expense of other people or not. But regardless, it's better for US to try and get off on their front foot and trying to go against China, who has the full strength of the government behind them,
Yeah.
also on this tech plan.
Yeah, 100%. I think that's a great overview of kind of what's been going on with the US and what's going on the other side of the world and how the US can prepare itself moving forward. But something else to switch it back into what's happening back at home. We talk about private credit a lot. We talk about, are the underwriting standards closely watched enough? Are they too loose? So here we have a little story about Goldman Sachs um, and their lending division, their business development company. It's a publicly traded stock where they make private credit investments, primarily a lender to middle market corporations. And one analyst had them ranked 25 out of 26 in publicly traded BDCs. So for a company for a firm bank like Goldman Sachs, that's not a great rating. That's comes as a great surprise, probably their lowest ranked division that I could think of. But it says that NAV fell 20% since 2021, and a lot of this was due to making some poor loans. A lot of it companies that probably should not have been given the amount of cash at um, the lending standards that were provided. So, I don't know. That's kind of a little overview of what we have. Maybe Adam, if you have any thoughts, takeaways on this article, kind of what's going on out there.
Yeah, I think that there are a few things that I mentioned that were interesting just to go into some specific lines. So there's the thing called paying in kind as opposed to paying in cash. So we've seen a pickup in that, and particularly private equity sponsored companies. I think I saw somebody on the news say 15% of private equity sponsored companies are paying in kind. So what they're basically saying is, we don't have the cash to make interest payments now, so come back to us in a little bit, and those interest payments will continue to accrue. And so maybe that works for some of these companies that are growing really fast, et cetera. But you would think in a publicly traded vehicle like this, and supposedly like all of these companies are investment grade. I remember seeing a Mark Rowan quote that saying that there's a $41 trillion private credit market out there, and 39 trillion of it is investment grade. And I think that that just can't be right with like how many losses some of these companies are taking, and just how many loans that there are, and how many good companies there are out there, that like it can't be that over 90% are investment grade. And I think that like when you're looking at a company like, an example is Pluralsight was operating at negative margins when the BDC lent to it. And Goldman execs say the BDC stopped originating loans for companies that aren't generating cash flow. Well, no duh. Like that probably should have been your first priority if you're the first lien senior lender, is trying to make sure that this company is actually putting off some money to pay you back. So I think that there are a lot of things that here that just scream that maybe the right sort of standards weren't being held to, like you said. But I'll pass it back to you if there's anything else that you thought was kind of interesting here.
No, no, yeah, great coverage. Like we saw earlier this year, First Brands, Tricolor, two similar situations, reputable companies that we thought were investment grade, but could not make their payments, and kind of a larger theme that's happening in the world of private credit right now. And a lot of people are worried, and this is kind of a reflection of that. Although they have said that they've replaced a lot of their staff, brought it under their larger asset management wing, and have been originating stronger loans for the time being. But I thought, from a place like Goldman Sachs to be struggling in this regard is surprising.
hmm And one other thing I thought was interesting, just to look at the different industries they lend to, and I got this from their investor deck, but over 25% is in software. I think it was like 18% software, another 8% in healthcare tech. So that's a big part of their book. And I think what's interesting about investing in business like that, and technology businesses that are, I mean, on one hand, they're exactly what you want, of being high margin, have a lot of recurring revenue, probably low capex, and like these tech and likewise businesses. But I think the other thing that maybe people underestimate is just how fluid a landscape tech and software can be. That like when you have a million different startups looking for a piece of the pie, and a million different people trying to innovate what you do to a better level, I think it's like, yes, it's great that you have subscription revenue, but on the other hand, I think it's like an easy thing for your revenue to go from 100 to zero in a pretty fast way. So I kind of wonder like what are the best loans for these people to be making? Like are they to oil and gas, or whatever it might be, of places that like maybe are lower margin, higher capex, but there's less of a probability that they have no terminal value, which I think is the case for more software companies than maybe we could guess. Uh, yeah.
Yeah. Agreed. Agreed. Good point. Kind of staying on this loose underwriting topic, maybe we could jump into this Berkshire story.
Yeah, so I thought the story was interesting, and This won't be the best overview ever, but there was a story that came out in the journal talking about how Warren Buffett, who built Berkshire Hathaway as part of an empire through investing in insurance companies, one of which being Geico, and now private equity firms are trying to get into the game, particularly through annuities. And we've seen Apollo buy a company called Athene. KKR is a company called Global Atlantic. I believe Ares has an insurance firm that it is partnered up with. And I think what this article is trying to do is really show how there are two different strategies almost that are happening here. You have Buffett's playbook, which is more conservative underwriting, hold more cash for a rainy day. I think it particularly Buffett's focus is on more property casualty insurers, so maybe it's just a slight strategy difference, but also just simply invest the money simply. So invest in normal stocks and bonds split, less leverage, probably very little private credit. And also by having that cash, you're able to kind of strike if there ever is a rainy day. Like in 2023, where there are a bunch of natural disasters, other insurance companies aren't doing so well, better opportunity to expand. But what private equity firms are trying to do is in the annuity space is that you can buy policies that will pay you a certain fixed amount over the next 7 years. And you can kind of match up to say, okay, this private equity firm is going to pay this sort of increment, or this private credit loan is going to pay this certain incremental cash flow. So if we can match these up and generate another 300 basis points, 150 basis points somehow, that they're going to try and do that and probably get a lot more fees for doing it, and maybe it's better for retirees if they can get a better policy by these guys generating more money, but maybe there's also excess risk entering the system. So that's kind of the long explanation, but passing it to you now to see what your thoughts on this piece are.
Yeah, no, well said. Kind of just looking at the history of it, typically these insurance companies are investing in US Treasuries. So post 2008, when rates went to near zero or zero itself, and you aren't really getting much return for these Treasury bonds, that's kind of where the opportunity came in, and Apollo stepped in and started promising some greater returns for these retirees, as you mentioned. And it is attractive. I mean, if you're, an aging middle-aged person and you're trying to compare returns very, I'm going to say naively, not in a negative way, but just that you don't understand totally how much risk you might be taking on here. Not that we're really seeing too much risk kind of coming back to bite you yet, but it seems very attractive. And for perspective, Berkshire under Buffett wrote 9 to 10 cents of premiums per dollar of capital in 24, while the rest of the industry wrote 87 cents. So clearly, Berkshire's taking a much more modest approach. And especially when you're talking about life insurance, for example, this is money that really needs to be paid out. And if you're making speculative investments and borrowing against it, and some private credit type deals, um, things could, not end too great if there's a recession, some sort of crash, or if a lot of these loans you're giving out can't be repaid. So thought it was good to bring this to everyone's attention.
Right, and I had a similar question to what you had about like how much people like really understand the risks that they're taking as far as them being paid out. And I think that one thing that I think about too is just that this is clearly in the private equity firms' best interest to try and lock in a permanent capital source like this that oftentimes is a lot harder to get because there are a lot of people who want to give you their money, wait 5 years and for you to give it back. And for them to buy an insurance company like this, which continuously puts off money, and you can kind of do the duration matching so that you can permanently manage that money and grow fees. off of that and have permanent capital, continue to keep investing in businesses. That's something that is invaluable to these sources who are continually, and what could make these private equity firms go away is having a ton of withdrawals, and all of a sudden you have no more money to manage. But if you have one of these insurance companies, maybe you have that evergreen money that people want. And I think that's another reason why we've seen BDCs emerge. Like they're private credit funds, but if you're in a BDC and Goldman Sachs can continuously get fees off of your investment by being in a permanently traded vehicle, like the Goldman Sachs BDC is, I think that that's something that they look at more favorably. Um, but I think this is another, and why I use that word untested at the beginning is like to what you said, we'll see like how this ends up working out. Like maybe these guys are right, and in a downturn, these private credit assets are super liquid and you can sell. But between you and me, like I doubt it. I doubt it. I doubt that these will be sellable to pay for people's insurance payments, because you have to have someone else who really understands like XYZ random $100 million loan, and is willing to make a trade with you when they know that you're distressed and need to make the trade. Um, I'm skeptical, but again, we'll see. I mean, maybe there's a super liquid market around this stuff soon enough.
Yeah. Maybe that's the phrase of the year. We'll see, or we'll see how this plays out. I feel like we say that after everything, but maybe we just don't want to jump the gun too much. But also, just one more thing I thought was important to add on to this story is that this is almost a regulatory gray area
Hmm.
of if it's Goldman Sachs public fund, then you have the SEC looking at you, but these are private equity firms and they don't necessarily have to report what's going on internally. So you don't know how good these loans are looking, how many, delayed payments are there, are these distressed loans? So something else to think about.
Until they needed a bailout to pay out these retirees, then they'll probably share their books. But
I guess
until then,
that'll
let's let's close out for this market predictions for 2026, and then we also have this article on affordability. I'll let you decide where you want to take it first, and we'll go there.
Maybe we can kind of jump into this article real quick, just because this is one of the major themes that we talk about a lot. We talk about wealth inequality in the United States, and top 10% is 70% of the wealth, and just kind of how that's playing out. But something I thought was interesting, Journal just came out with this article, is that this is also true for corporations right now. So big corporations had an outstanding year, earnings growth, really strong numbers while smaller companies, small businesses, not doing so hot. Inflation's still high. Um, as we talk about, consumers are still cautious, and tariffs have been an extra burden compared to these big companies that can kind of just they have larger profit margins. They can take on more debt and, manufacture ways around it. These smaller companies can't. Um, Said private firms with under 50 workers cut 120,000 jobs in November alone, according to ADP. So, um, small businesses, this is classified as any business with up to 500 workers, employ nearly half of the American workforce and make up 40% of GDP. So, this isn't like kind of something to brush over. I thought this is something pretty substantial, and it's kind of just showing this wealth divide that we have now, and not just from individuals, but also with companies.
Right. And I thought that the graph that was in there on the cumulative change in employment by firm size, we've seen or we're seeing 500 plus. It looks like it's going straight up, and 1 to 50, basically the opposite story. I thought that maybe I'll just give a line to give the viewers some context. This reads goods like wine, cheese, and replacement parts for equipment. This is talking about the restaurant sector, have gone up due to tariffs, but labor, rent, and insurance have also soared in response to these shortened worker shifts and has not replaced employees when they left. Um, so I think that this is just kind of an anecdote that gives just some of the insight into what's going on about there being a real cost squeeze on some of these firms of how like a lot of their major expenses of rent, insurance are stuff that that they're having trouble meeting those obligations. And I think that we've also seen it being hard on the revenue front because if you're a small business and you're in a small community that's also serving people who aren't doing as well, who are also small business owners, that there's just less money to trickle through. So if you have a revenue side that's not so favorable to you and the cost side is not so favorable to you, what you're going to lean on is trying to look to the capital markets and to financing to kind of hold you over. But a lot of these firms operate on lines of credit that are directly tied to the short-term interest rates, which are still relatively high, versus if you're a company like Amazon or Prologis or just some major company that you're probably able to stretch out your maturities and you're still paying like some weighted average like 3% interest rate, whereas these guys are probably paying 8. So it's just a whole different ballgame when you are that small size.
Right. 100%. Yeah. Size is definitely difficult. It also mentioned that retail and professional services struggled the most here.
Mhm.
Also, kind of mentioned restaurants. 90% of restaurants are small businesses, and they've really been struggling as well. And one practical example maybe viewers can relate to is that a lot of office holiday parties are turning into happy hours versus renting out a table or renting out the bar. So there's just kind of little things that are happening right now that I feel like are accumulating, and people are starting to feel the squeeze and have been feeling the squeeze. And that's kind of another big word for the year. You could talk about affordability. I think it drove a lot of the elections this past November, and it's going to drive elections moving forward. So maybe we could jump into some predictions or maybe what needs to happen next year um, for maybe this trend to reverse itself, or maybe just things that you would hope to see moving forward.
Yeah, I think you're spot on with that. Affordability, because I think that like, even thinking about this mayoral election in New York City, that kind of both sides are really focused on this affordability issue, and people are trying to figure out who can solve it best. I think I don't know, if I'm thinking about my predictions about what might happen. I think that, or something I'd hope to see on the affordability front is for like people to really think about like what long-term solutions are going to look like and things that are a fair compromise between both firms and the country as a whole and trying to make sure that we stay competitive with folks overseas. And to be honest, I'm not so sure what that looks like because obviously that you can continue to kind of tax people and try and redistribute wealth and do it that way. But at the end of the day, like you have to find a way for small businesses to have some sort of piece of this economy because we really focus on tech and platform companies that, by their very nature, are things that are scalable and sprawl the entire economy, and by definition aren't small. So it's a tough issue for me of trying to figure out what the right way forward is, and I think that's probably why we haven't found it yet.
Yeah, I don't know if anyone knows the reason, but I like where your mind's at. Um, I think that something else we could think about in terms of this year is divergence. So maybe the economy isn't as strong. Maybe, hiring is basically non-existent.
Hmm.
Inflation's still not at a great place. Unemployment's going up. But the market continues to soar. So a lot of people can kind of put their hands up and say, okay, you know what? This is just the world of AI. This is the way it's going to be now. But I am hopeful that there could be some other solutions. And we've talked a lot about smaller businesses and keeping competition in these fields and the amount that this can do to workers, salaries, what it can do to an entire community. Um, Maybe finding a way to help out these small businesses. And as we see, they have had a very tough year. And if a few more small businesses go out of business or Larger companies are continuing to acquire these small tech startups. Um, I don't know. I don't know if that's the right direction, but those
I
are some
think
thoughts.
Yeah, people are going to be like increasingly upset if that stuff continues to happen too. And I think that that'll just be another uh, thing that's going to impact the politics in the US and thus like the economics in the US of what that looks like. And one thing that's kind of unrelated that I want to say too about just on what happens with China going into next year is that trying to watch, I mean, watching Taiwan and watching to see if there's some sort of major event that makes US-China relations come to a head because I think that we've kind of competed indirectly over some issues. I think like with this, I haven't read too much into the Panama Canal situation, but there's been some heads butting there as well. So trying to see what the ultimate equilibrium is, because right now it still feels like we're building to something.
Right. Yeah, it feels like we haven't gotten to that point yet. And now there's even potential military conflict coming in Venezuela. So
Mhm.
more and more uncertainty.
Future Vita of exchange topics for sure.
Exactly.
But I think that's all I got for today, unless you got anything. I think we really appreciate you spending this time with us and glad that we were able to bring these stories for you today. I was again pleased by how well it wrapped together.
Yeah. Yeah. Some interesting predictions. We'll see how everything unfolds moving forward. But again, thanks for everyone for listening to us. We'll be banging out some more episodes soon.
Awesome. See you all.
Take care.